Welcome to Stony Finance Lab channel.
Hi, my name is Carl, along with our group members Aaron and Marina, and this is our video for saving for a down payment on a house. Money drives many decisions that we make day to day. Setting goals can help us take control and feel more confident about those decisions. Everyone has their own personal financial goals that differ. There are financial goals that can be set for short-term or long-term. As graduate students, it's important to start a plan for a down payment on a house. Our target group that we want to identify are upper-level college students who are around 21 to 25 years old. If you don't have a credit card, it is important to get one as soon as possible to build a good credit score. These students must have a great credit score of 720 or better and make around $55,000 a year or more. Our group's goal is to help our target market start saving for a down payment on a house in Long Island. This goal would take approximately 5 years to complete. The goal is to aim for around 20% on a down payment. For a small house on Long Island, it would cost you around $350,000, which would make your down payment around $70,000. 20% allows you to avoid buying private mortgage insurance. This is a common mortgage insurance that is required for conventional loan borrowers that make low down payments. Putting down 20% helps lower your monthly payments with a lower interest rate. Although 20% is also not the end-all be-all. There are low down options that are available for first-time homeowners. Most first-time homeowners only put around 6%, but it means you have to pay more money per month with a higher interest rate. Investment vehicles. Investing young is important because it allows you to be riskier in your portfolio. These are the vehicles that our group focused on. Asset classes focus on equities and some fixed incomes and money markets. Financial instruments include mutual funds, ETFs, stocks, bonds, and CDs. The last vehicle is the market, which includes stock market, bond market, and money market. Mutual funds. Mutual fund is a professionally managed fund that pulls money from investors who purchase securities. Investing a fixed amount of money in a mutual fund for a fixed time span can help make a down payment for a house. SIP mutual funds can be considered as valid options due to their benefits. It's extremely flexible because you can pay either daily, monthly, or weekly, and there is no need to time the market. The benefits of a mutual fund is it can withstand volatile market conditions because of its diverse portfolio, which reduces risk. It can compound your money through investments and returns. With an annual salary of $55,000 per year, try to save around 20% of your income. You save around $11,000 with regular contributions of $5,000 per year. Your investment could be worth around $43,000 with a rate of return of 4.8%. Certificate of deposit. Certificates of deposit is a long-term investment where you lock your money for a predetermined period of time. It's an extremely safe option because interest rates are unsurpassed. Your money that you put in the CD builds interest at a higher annual percentage yield. You have to wait for your money to reach maturity to withdraw it. A $15,000 deposit over 5 years with an APY of 2.25% can help you earn almost $2,000. ETFs. Exchange traded funds is a basket of securities that tracks an underlying index. They are very similar to stocks, but prices continuously fluctuate. SPY tracks the S&P 500, which is comprised of the top 500 stocks in the United States. The S&P 500 focuses mainly on technology companies like Apple, Microsoft, and Amazon. QQQ follows the NASDAQ 100 index, which also follows large cap technology companies. VIG, also known as Vanguard, is a high dividend yield ETF that tracks the S&P US Dividend Growers Index. These charts show the 3 ETFs we talked about in the last slide. If you invested in these ETFs in 2018, you could have seen around 100 to 200% on your investments, which is outstanding. Investment strategy. Our investment strategy helps give an active and passive way of investing. Mutual funds are actively managed and help gain your money in a long period of time. For people who want to risk more and get more reward, you can use an ETF to buy and hold your position. CDs are a safer option to help build your investment for a long period of time. Your investment should be around $1,000. If you can invest more, depending on your financial situation, the better. Try to save around $900 each month to invest into your portfolio. Any dividends earned should be reinvested to compound your profit in the future. Return. These are the results you will see if you start with an investment of $1,000, with contributing around $900 each month, you can see your total contributions add to around $54,000 in a 5-year span. You will gain around almost $13,000 in total interest based off conservative assumption of an around 8% annual return on our portfolio. Risk and reward. When investing money into the stock market, there is always risk to take account for. This includes market risk, political risk, business risk, and etc. It is really important to keep up with the current events to understand how the market will react. The amount of money you put in the market is your risk. The money you risk correlates to how much your investment can achieve. This means that higher returns comes with greater risk. Volatility shows how risky an asset is. If an asset is extremely volatile, it means the asset is risky to invest in. It can positively affect your portfolio or negatively affect it in a matter of days. Our ETFs Morningstar ratings show how well our ETFs are rated on a 1 to 5-star rating scale. The higher the rating, the better performance on its long-term profit of volatility. And this chart shows the risk and reward. As you see on the bottom, certificates of deposit is a low risk, low reward. And as you go up, the more you risk, the more your rewards are. How to alleviate risk. You want to allocate your assets by including different classes in your portfolio. This means by investing in stocks, bonds, and cash. This will hedge your losses from the market in case your portfolio goes down. Diversification is an extremely important tip in order to limit your risk. You must divide your money into different securities. Mutual funds are a great example on how to diversify your assets. The number one rule in limiting risk is to not put all your eggs in one basket. You do not want to put all your money into 1 or 2 stocks because if the market crashes, it can greatly impact your investment in your portfolio. Mistakes to avoid. Shopping around for the home, but not the mortgage. Buying more home than you can afford. Draining your savings. Moving too fast. You must trust your investments and never pull out too early. Miscalculating hidden costs of home ownership. Getting only one rate quote. Not checking credit reports and correcting errors. Making a down payment that's too small. Miscalculating repair and renovations. Principles for success. Save for the down payment and figure out how much home you can afford. The monthly mortgage payment and down payment should be around 20% to avoid paying more monthly. Get pre-approved for a mortgage. Figure out what you want in a house. Research and ask questions. Have a plan in mind and develop a budget. Our summary. This video is for postgraduate students who are looking to be a homeowner in 5 years who should consider using our investment options to get their goal. This will be done by investing in CDs, stocks, mutual funds. These aspects can help grow your money safely over a specific period of time. It is important to have a plan and set the timeline you want to achieve your goal. Try to save enough for 20% to make the down payment on the house you're trying to buy. Learn how to budget your life and learn how to save. After that, try to aim to invest 20% of your income each month. Thank you for clicking on our video. We hope you use our recommendations to eventually help put your down payment on your first house.
Thank you for watching this video. Please feel free to like, comment, and subscribe to this YouTube channel.